Good afternoon, good evening, everyone. Welcome to the Society of Professional Journalists Freelance Community's December program. We're glad you could join us today, and we hope you enjoy our program. I'm Hazel Becker, a longtime freelance journalist, former chair of the SPJ Freelance Community, which is bringing you this program. As you may know, the freelance community is among SPJ's biggest groups with more than 500 members. And you can find more out about us and access some of the resources we maintain on our hub on the SPJ website. Nicole, maybe you could go ahead and put the put our hub URL into the chat. Our topic today is the lowdown on taxes for freelance journalists, and I'll be interviewing Matt Apodaca, a managing partner in NorthPoint Tax Business and Wealth Advisory. He's joining us from Fullerton, California, where his firm provides tax and business planning advice to business owners wherever they're located. And full disclosure, Matt's my CPA, and I live in Washington, D.C. So just to show you, long distance advising can really work. Our behind the scenes technical coordinator today is Nicole DeCrescio, a newly elected freelance community board member for 2024. And many thanks, Nicole, for joining us and providing the background information and the technical support here. Just one quick housekeeping item, please. We plan to leave as much time as we can at the end so that we can take all your questions. Matt and I first will discuss a few topics we've outlined, and we do ask you to put your questions into the Q&A panel rather than the chat, because we won't be monitoring the chat. I think Nicole might have time to do that. She'll also be looking at the Q&As, but we'd really like you to use the Q&A panel for your questions. So we have a lot to cover, so let's get started. Matt, we know our audience comes from a variety of backgrounds, some new to journalism, some new to freelancing, but longtime journalists. People who work in all nooks and crannies of our industry. And I think everybody probably agrees that they have the same aim in filing taxes every year. They want to declare every bit of income that we're required to, and we want to take deductions for all the expenses we're allowed to take. Is that too much of a simplification?
Oh, it's a good goal for everybody. We want to pay less tax and keep what we make.
Okay. So not too much of a simplification, but aren't there some things that some cautionary tales, some bits of advice you have about things that are definite no-nos, things that we might forget that you want us to remember to put in our taxes?
Well, yes, you should be reporting all income on your return. So I'm assuming most everyone here is independent contractors. So it means all revenue that you've been paid throughout the year should go on your tax return, because that can come up in an audit.
I think you'll find that there are a number of people here who work full-time, or some of them part-time for another employer, sometimes in journalism, sometimes not. There are a fair number of people who freelance on the side of whatever else they do, because journalism's not a booming industry right now, and it's hard to make a living either as an employee or maybe in particular as a freelancer. So you'll find that not all of them know how to think of themselves as independent contractors yet, or as independent business people. Can you just, give us a real quick rundown on how to do it for people who are new?
Okay. So most of us are probably used to your typical salary or W-2 job where you're paid a salary or a wage from your employer. You get a W-2 at the end of the year, which shows how much money you made, how much tax was withheld. If too much is withheld, you get a refund. If not enough is withheld, you owe tax. And W-2 returns, where you're getting a salary or a wage, are pretty straightforward because it's mostly based on withholdings and there's some deductions, but most are pretty limited. When you're an independent contractor, it's a whole different world because usually when you're paid, there is no tax withheld. So you're responsible for making those payments at the end of the year or sometimes quarterly when you file your taxes. So to new people, it could be surprising that they get paid and find out they still owe tax to the IRS and to the states. But one of the big advantages of being an independent contractor is you are able to deduct most business-related expenses, and you're only paying tax on your profit, not the full amount you receive. And there's lots of case history and rules on what's a business expense, but it is a pretty broad category of anything you're spending in the ordinary necessary course of business to keep clients, build relationships, to do your work, and to perform your duties. And I'm sure we'll get to more specific questions, but with independent contracts, you only pay tax on your profit, but you need to plan ahead for that each year so you're not surprised by the tax bill.
Okay. What kind of things can I deduct?
I'd really like to get more to specific questions, but if you're spending any money out of pocket to do your work, so if you're working out of Miami and you're required to fly to Nashville to do work and it's not covered by whoever's offering the job, that plane ticket is a deduction for you because you're spending money to go get to that work. So when you're spending money on something related to your work, buying direct equipment, having to travel to a location, or spending money out of pocket to perform that work, it is a deduction against that income.
Okay. And so what about things like my computer?
Absolutely. So if you're using your computer for most of your work, and it depends on levels of how intense or not intense you're using it. So for example, if you're a writer and you're using your computer to write most of your article novels, we usually take the full amount because it's a business use asset. If you're only using it 25% of the time for business, either 75% of the time personal, we take 25% of the cost. But that's a great example of if it's something you're buying that you need to do your work, it is absolutely a deduction, and we want to make sure to take it.
Okay, good to know. Questions about deductions are starting to come in. So we have a food writer named Jackie who's with us, and she says that a lot of that as a food writer, she has to eat out a lot, and a lot of it's general research, not specific to an assignment. And she'd like to talk more about deducting expenses like dining out when it's not for a specific assignment. Can that be done?
That is a great question. I like that scenario because the question is can I deduct most of my meals? And how the IRS looks at that, if it's just basic food to keep you alive, that's not a deduction. So you're stopping by to get a salad somewhere, that's not a deduction. But anything else, you're trying food in a new part of town, trying food at a new restaurant, reviewing food somewhere, if it's related to your work, it's a direct deduction. And it's not limited to 50% in that case. It is a full 100% deduction because that's part of your business, is understanding the market for that.
Ooh.
So it does take a... Go ahead, Hazel.
No, I said that's interesting.
Yeah, it does take a little bit of discretion because it needs to be reasonable. If you're taking your 4 kids out to dinner at Spaghetti Factory, they're probably not going to allow that. But if it's you trying a new pasta place to see if it's a good fit for the articles you're writing or for a review, that's absolutely deduction. So it is a bit of a gray area. You don't want to mix in too much personal use, but to the extent that it's business use, it's absolutely deductible. And I've seen that kind of thing allowed in various audits in the past.
Hmm, interesting. Okay. And so what happened? How do you deal with the reimbursement that sometimes if you're, for instance, have a day job, I mean, and by that I mean you're paid a day rate. A lot of broadcast people, for example, are paid day rates. And they're going to give you a stipend for your meals. But you spend more than that. Can you write off all of it? Or, I mean, how do you deal with that?
So when you're getting a stipend, that stipend itself is generally not taxable. And if you're spending more than that above and beyond, it's usually a deduction either as a travel expense or a meal and entertainment expense, depending on the tax that you're using for. So if you're getting $50 for food and hotel and you spend $90, that $40 difference is a deduction because it's money you're spending out of pocket. You're spending your earnings to do that job. So we do deduct that and you only pay tax on the net profit. And you're going to hear me say profit a lot. That's a lot of my goal is to make taxes less worrisome and less scary for people. We want you to pay tax on what you take home after all expenses, not tax on the money you make before these kind of things. So if we're spending more than stipends, that's absolutely a deduction.
Tell our guests how to figure it out when you're just starting out to freelance. And so you don't really have income yet, but you have to buy the equipment ahead of time. Or let's say you just sold your first piece and you bought a laptop 2 months ago. How does that work?
So you generally will not pay tax until your business turns a profit. So I don't know the industry well and the cost, but let's say you're working in the audio department and you just spend $10,000 on specialized audio equipment. You spend $10,000 in 2022 and you do not start making money until 2023. We show the expenses on the 2022 tax return. They're unused and they roll forward to offset the income you earn in 2023. So if we earned $15,000 in 2023, we spent $10,000 last year that we couldn't deduct against business income. It does roll forward so that in 2023 you're paying tax on $15,000 that you earned minus the $10,000 in equipment you purchased. So $5,000 profit is what would be taxable on your return. So if you're starting up, keep track of all those expenses because those are all deductions against future income. It may be a couple of years filing, but it's all deductions that will offset future income. So it's helpful to keep track of what you're spending money on.
Okay, so let's see. What happens if I have expenses and I mean, can you talk a little bit about the difference between accounting for your business on cash basis versus accrual? And are there ever times when a freelance journalist would want to be on an accrual basis, and explain to people what it means, the two different ways?
Most small businesses operate off the cash basis, which means you're only paying tax on money when you receive it, and you're only able to deduct expenses when you pay it. So I work with some larger businesses, and they may have $1, $2, $3 million in receivables. They've billed clients for something, but they haven't collected the money yet. We want them on the cash basis so they're not paying tax on money they haven't received. So most receivable heavy businesses, we want them on the cash basis. So the tax you pay is matching when you collect money. On the other side of the coin, paying expenses, sometimes accrual is helpful because you can deduct the expense, let's say the end of this year, if you have a bill, but you're planning on paying it in January. But you can't have it both ways. If you're going accrual, you report income that's in process, the income that you've billed that haven't collected, and you deduct expenses that you've received the bill on but haven't paid yet. But because of that, most people use the cash basis where they're deducting expenses when paid and reporting income when collected. One of the questions we always get about this is, it's December 27th, I get a check for $20,000, but I don't cash it until next year. So it's not income until next year, right? And the unofficial answer is, yeah, it's not income until next year, so you cash it. But the official IRS answer is the second you touch that check, you had constructive receipt of it. So in the eyes of the IRS, they say that's 2023 income, because even though you didn't cash it until January 2024, you received it in 2023 and you could have cashed it then. Now, that's a difference between the real world and what the IRS says. Most people still operate on the theory of if I cash it in the next year, that's when it's taxable. But those are the kind of things to be aware of. Cash basis means when you receive it, even if you receive a check, that's the year it's reported as income.
Okay, so you're talking about the way the IRS looks at things and the way that perhaps the tax code looks at things. But in our real life as freelance journalists, they don't always separate out what they're paying us for reimbursement for our meals, for example, our stipend for meals. They don't separate that out from the fees for our business. So is it okay then to just put all of that into income and then write off all the expenses? It all comes out the same way, doesn't it?
Correct. Because we want to pay tax on the true profit, not inflated profit, because they're including the reimbursements in income. And we see that a lot in our business, where we'll see a 1099 that we know is high because it might include, I'm making fake numbers, but it might include $30,000 of reimbursements for the year. So we usually have to list that out on the return showing the true earnings were only 60,000. This additional 30,000 is reimbursements. So those reimbursements are not taxable. We show the money coming in, show the money coming back out in the tax return, and then through the normal deductions and income. So you should not be paying tax on reimbursements as an independent contractor.
So is it okay to do it the way I've done it for years and you may not have known, that I put all of my income, because on the 1099, it shows it all as money that was paid to me. And then just take the all the deductions for all the expenses along the way. Does that, the fact that it comes out to the same amount of money, is that okay?
That's completely okay. That is completely okay. I've been through that in audits too. Regarding audits, there's about a 0.5% random chance of being audited when you're a small business under 200,000 of income. So it's not high, but it does happen, and I help with a good amount of them. And I've worked with auditors just showing these reimbursements that you're explaining, Hazel, and they've never had an issue with it as long as there's some sort of other trail besides just the 1099. Contrary to sort of Hollywood and popular belief, most IRS agents are very reasonable if you are kind and respectful to them. Most audits go bad when people are rude to the agent or purposely make their life difficult. The old stories of putting them in the closet and cranking up the heater. That won't yield good audit results. But if you give them good information, respectful and timely, they're people too, and usually they're understanding of those kind of things.
Okay, that's good to know. Good to know. So, tell me about travel. Sometimes I've had to go on a business trip, and as a freelancer, I put out the money for that. What can I write off and what can't I write off? And and then go a step further, please, and tell us what happens if then I stay an extra day and take a hike or something like that. Do mix business and pleasure.
Well, that's always the best, mixing business and pleasure. In the simplest example, if I take a business trip to a conference, present for 5 days, meet with different clients and prospects at dinner, and I'm only there for business, I'm not bringing my family, I'm only paying for meals with clients, prospectives, 100% deductible, really no questions asked. It's very easy to go through that. So let's say you stay a couple extra days to do something fun. That's also no problem. They say the 5 days you were there in business is deductible to the extent it's business. The 3 extra days you stayed to go to Disneyland, to go on tours, to go scuba diving, that's all personal. That's not a deduction. If there's a plane ticket in there that covers the entire trip, the official IRS answer, if you get the nastiest auditor on a bad day wanting to really make an example, is they disallow the entire plane ticket because it had personal use. The real world answer is most auditors would say, okay, it was 70% business, 30% pleasure. You could take 70% cost for that ticket. So in those scenarios, it's pretty straightforward. Where it gets tricky is if you bring your 2 kids, your parents, your spouse with you on that same trip. Generally, to separate all the related costs to bringing people along who are not doing part of the work that you're doing, that's not deductible. And it doesn't need to be complicated, but if there's 4 of you and you get share one hotel room, well, now only a fraction of your hotel room is deductible instead of the whole thing because you're bringing other people and it's personal use. That gets into a lot of gray areas. So I usually advise it, you have to look at what's the real percentage of personal use versus business use on these things. And the IRS is usually accommodating if it's within reason. Give you 2 examples. Had a few times where people brought their family on business trips. The IRS allowed the full hotel, the full travel. They just didn't allow the afterwards tickets to Disneyland and everything else. On another example, had a really aggressive client that took a Mediterranean cruise, claimed they were working and tried to deduct the whole thing because he logged into his email a couple times during the trip, and the IRS disallowed the whole thing and slapped them with 35% penalties and interest. So it's hard to give a cut and dry answer on a lot of these things, but you got to use your own judgment or the judgment of your CPA in some cases. If it's heavily personal, we need to reduce it to reflect a true business percentage. If it's mostly business, we're going to take the deduction because we want you to only pay tax on your profit.
Okay. And what if I am going abroad? Are the rules the same?
Yep, if I'm flying to London for a conference, for a job, and solely doing the job, maybe staying a few days for fun, all the work-related expenses are deductible against our self-employment income, and the personal expenses are not. So it's the same concept, just the numbers are a little bit bigger because of the cost of international travel.
Okay, good. Now, a lot of freelancers work at home. Some of them don't. Some of them have offices or whatever, and I know they can write off their office and stuff like that. But I also know that when you work outside your home, you can't take your commuting expenses. But when your office is in your home and then you have to go and do an on-site for a day at a client's office, can you take those expenses since you're starting out in your office in your house in the morning?
Yes, but the rules have evolved on that, where originally the rules state your commute to and from work is not deductible. I live about 10 miles away from my office. It's a 15-minute ride some days, an hour ride another day, depending on traffic. But that commute back and forth is not a deduction, regardless if I'm meeting people in the office or not. But I have a home office, and if I'm driving 30 miles to meet a client for a meeting or for a lunch, that's a deductible expense because I'm coming from my office to meet with someone or for a job. All those commuting expenses, Ubers, Lyft, mileage, gas, train tickets, bus tickets, plane tickets, any of those things are deductible. It's just your back and forth commute is not deductible. And same rules, it needs to be business use. If you're meeting up your friend to catch up and drink some coffee, that's not a deduction, even if you spent 5 minutes talking about business. But if it's a true business meeting, yeah, the whole thing is deductible. That's exactly what it's there for. It's a legitimate expense. So going to and from your main office, not a deduction, which I know we have a lot of main offices in the freelance world, but from your home office to different locations for work, all of that commuting cost is deductible.
Okay, good to know. Now, I and a lot of freelancers that I know and a lot of journalists that I know give donations to journalism organizations. Like I give money to SPJ, for example, as a charitable donation. Can I take that off of my business income?
Well, you should always give money to SPJ. That's a great cause there. I'm going to try to give the book answer, the real world answer, to help clarify the difference. So the IRS answer is if as an LLC, an S corporation, or an individual, if you're giving through your business, it's considered a charitable expense and it goes on your Schedule A. So it is a deduction, but it's in a different category on your return. And if you're not itemizing, it may not help as much. So it's a deduction, but it's not on the business schedules. It's usually on the personal Schedule A, which is for itemized deductions. Now, I know we're being recorded, but I'll still say this. Oftentimes what small businesses will say is, well, yes, it's charity, but it's also sort of advertising. I'm getting my name out there, and they'll put it in an advertising category. So it is a direct business expense. And where I see that help people is if they don't itemize and they don't get any benefit for that charitable expense, putting the $100 as advertising can help them. That is a gray area. It's a little bit aggressive, but that's the real world answers. A lot of people will classify that as advertising, knowing the IRS can challenge it, but if it's smaller, it's really not too big of a flag there.
Okay.
So a lot of the tax world is about materiality. If it's $100, I want to call it advertising. If it's $10,000, I say, no, that's too risky. That needs to be a Schedule A deduction.
Okay. We have a question that was posed ahead of time. It's not in the Q&A panel. From someone who writes for television and does production. And she writes off half of her cable expenses or subscription TV or whatever because she has to watch a lot of shows. She really can't do her job if she doesn't do that. It hasn't been an issue for her so far, but is it a red flag? Are there other write-offs that she should be thinking of taking?
I don't see that as a red flag at all because it is part of the research for her business. I mean, it needs to be within reason. If she's specifically working on, let's say, Marvel superhero movies, and all of her subscriptions are to Hallmark and Lifetime, the IRS may say, well, you're not really in the same category. But broadly speaking, if she's researching stuff that's in her area, in the general area she's producing in, yeah, that is research. That is a completely deductible expense. And a lot of the IRS looks at, is this within reason? We have no problem with people deducting part of their cable bill if they need that to research for the different shows they're producing. It's when people sort of take it too far and say, you know what, I'm deducting my family's $20,000 Disney cruise because, well, it's sort of related to Marvel and I'm in the show business, so I'm taking that as a deduction. Those are the kind of things where you sort of turn the IRS agent off to you, say, well, I can't deduct my cruise. Now I'm going to make an example of this person. So you always have to think of it, what's realistic versus what's squeezing. And it's the same thing with the home office deduction. If you're deducting 10 or 20% of your total house payment, utilities, maintenance, generally the IRS isn't going to give you a problem. But if you're saying the pool I'm installing, the island barbecue, the AstroTurf I'm putting in my backyard is all part of my business expense, they're likely going to give you a hard time on that. So keeping it within reason and thinking about the perspective of the IRS agents don't get paid a lot. And if they see someone deducting a large amount of something that they normally outside of their reach, it may not end up well in an audit. A little off topic, but a great example of that. I help a lot of doctors, various surgeons, and I had a heart surgeon that really, really wanted to deduct his Tesla, it's a $120,000 Model Y, as a business use vehicle going to and from the hospital. So explain, you can't do that. And he was adamant it was business use. And I joked and said, well, are you performing heart surgery in the back of your Tesla? He said no. And we sort of explained to him that for an IRS agent to see you deducting that kind of vehicle when it's more money than they make during the year, it's not going to set a good tone for the beginning of an audit. Now, if we did that in a more reasonable way of he's going from his main hospital to a secondary hospital, we're taking mileage, no problem. If we try to take the entire $120,000 vehicle as a full business expense, that's where it's going to sort of be outside the scope of what's normal for the IRS. So you have to think of these things in what's realistic and what just looks blatantly wrong should someone look at it.
Okay. About the home office deduction, a lot of people rent, and they find that they're doing all their work, their freelance work, in their dining room. And one person wrote in the Q&As that that they use about a third of their apartment, the dining room, as a working space. Can that person deduct a third of their rent?
A third is usually as high as my office is willing to go for business use at home. But in those circumstances, if it's a smaller apartment and it's truly 1/3, I would say absolutely. You may want to snap some pictures just so in the rare case you're ever audited, you can show them, here's the workspace, here's the full layout. And again, it doesn't need to be an engineering design of it, but just showing that it's a small area, I'm paying rent, here's the portion I'm using for work from home. In my opinion, that's absolutely deductible because that's part of it's the same as paying rent somewhere else to rent a place. It's going to be a cost there. And I've seen those go through an audit without any issues. For business use at home, we're also get a safe harbor of $5 per square foot up to 150 square feet. So it's not a huge deduction, $450 total. But the safe harbor $5 per square foot, the IRS basically says we're not really questioning it as long as the space exists, or you're taking a percentage of the total cost that they could scrutinize a little bit more. But in the example of someone using 1/3 of the total apartment, I'd say 1/3 of the rent is absolutely fair given the circumstance they have.
We have a couple of people who have asked questions about your comment that business-related food expenses might be reimbursed, well, might be written off at 100% versus 50%. But what's going on there? The forms seem to say that you can only write off 50%.
Oh, that was in the context of the person who's in the food industry. So if the person who job was in the food industry, that's a direct research cost for their industry. But unfortunately for the rest of us, it's 50% if we're not in the food industry spending money on meals. However, the past couple years, if you're for some reason, part of these sort of crazy changes that are happening year to year, if you're eating at a restaurant with other clients or with a meeting of like a group like this at a restaurant, that is 100% deductible. Don't know why. So most people are claiming most of their meals are at restaurants, but for the past couple of years, it's been 100% deductible. We're sort of used to that 50% rule for normal meals and entertainments, but eating at a restaurant with clients or with people in the same field for business, that is a 100% deductible expense under current law.
Wow, I didn't know that. And I covered taxes for 15 years, but see, you said that that's new. It's just the last couple of years, right? Okay.
Yeah, it was with the Inflation Reduction Act, or one of the big ones before that. I mean, we've had the past 3 years since COVID has been the most changes in the shortest period of time in the tax world. And thankfully, we're past the PPP and ERC and all those other crazy credits out there.
Right. Some people have used resources, not services, but resources like H&R Block or TurboTax or some other program. They, it can be pretty easy to do your taxes, not cost very much to use the H&R Block if you're an employee, but now that you're a freelancer, does that complicate things to the point where you really need a tax professional?
I'd say under 50, maybe even 100,000 of self-employed earnings, you may not need a tax professional because it's a simple Schedule C. That's part of the forms on the 1040, which is where you're showing your self-employed earnings. So it's your total earnings for the year minus direct business expenses, business use of home, maybe some depreciation. Where if you're keeping somewhat good accounting records, whether that's an Excel spreadsheet, handwritten, or through QuickBooks, it's usually pretty straightforward. I brought in $60,000. I have 20,000 expenses. I'm paying tax on 40,000 of profit. It's important to plan ahead so you're not having to pay that all at once and be surprised by it. But most software can run that pretty well. Where I see the problems coming in is if someone is really aggressive with those deductions without realizing it, or even worse, being aggressive with those deductions and realizing it. So, for example, sometimes credit card math is a little bit tricky. I had someone who bought $10,000 of equipment. It was video equipment. So they deducted the $10,000. Then when they paid off the credit card for $10,000, they deducted that $10,000 again. And I can't see everyone on the view, but I'm sure half people are shaking their heads saying, oh no, they deducted it twice. And some people may say, what is he talking about? When you swipe the credit card, you get the $10,000 deduction. You don't get a second deduction when you pay it off. And sometimes I see people make those mistakes just because they're in a hurry or they're not really watching it. But that goes back to more of their tracking of their expenses versus anything with the tax software. The other thing is making sure the expenses are reasonable. If you're making 70,000 self-employed and showing 120,000 of travel expenses, that's probably going to set a flag to the IRS because they're saying you have more expenses than your income in one category. How are you surviving? We think it's going to increase the audit risk of that return. So in general, I think a lot of the smaller returns can be self-prepared with TurboTax or maybe the lower cost services. You just want to sort of look it over and say, does this reflect reality? Is this what I brought home after expenses? And if it does, I think you'll be fine. I don't think there'll be too much challenge even in an audit. It's if it's not reflecting reality and you win the audit lottery, that's where it could be more painful.
Okay. Um,
I think the second half of that question was what receipts should I keep for these deductions?
mhm.
Um, First, there's a 3-year statute limitations. So for example, our 2023 tax returns are due April 15th, 2024. So April 15th, 2024, April 15th, 2027, that return falls off the statute of limitations, which means the IRS can no longer open up that return for an audit unless they believe that there's fraud or there's significant omission of income. What that means for most people is after 3 years, it's beyond the statute. The IRS can't open it. You sort of got to be like on a really bad list somewhere for them to open it beyond a 3-year statute. So that's the first thing. Is you may have some old records that you may not need anymore. Second is they do want to see receipts are best. And since we live in a digital age, I always recommend scanning these things. Scan it, save it somewhere in the cloud. You have to worry about it, and it's there if you need it. If you don't have receipts, they will go off of credit card statements and bank statements if you have copies of those clear checks. And most banks keep those records for a number of years. So if we've got another small business return and there's $30,000 of equipment, I suggest keeping those equipment receipts because that's a big deduction in your return. The smaller things you can usually get by with credit card statements, with bank statements. Receipts are preferred, but know that as long as you have some sort of record, you can show the IRS that this money was being spent. If it's a reasonable agent and we're being on their good side, it's usually going to be okay. When they give you the most trouble is when there's no credit card statement trail, no bank statement trail, no receipts, and the deduction looks really, really high for the average. So receipts are helpful. They are preferred, but I know we all have boxes of receipts. It's just a matter of getting it scanned to save it, and that way it's out of sight, out of mind for you. Again, as much as I'm being really nice to the IRS, but I also want to point out that they've been able to help a lot of people. We've had people who've sold houses that they've owned for 30 years, and I don't have the receipts when I did a home improvement in 2005, and most people don't. The IRS is usually reasonable with that. They've been reasonable with us. We've gone through many property sales as long as the improvements are within a reason for how long the house has been held. So what I'm saying is, of course, you want to keep the receipts and get them scanned, but it's not the end of the world if you don't have them, as long as you have bank statements, credit card statements, or something else supporting those expenses. Cash expenses, while they may be convenient, don't have a trail, so it's generally discouraged as you grow in size to not use cash expenses, but use things on your credit card and get some points along the way.
One of the people in the Q&A asked whether they should have a separate business credit card.
It's not needed, but the short answer is yes, because it makes your life simpler. So if you're keeping only business transactions on a credit card, it's much easier for you to keep up with your own accounting, because honestly, we only do it at the end of the year. So if you have all of them on credit cards, it's a lot easier for you to go through and say these are all business expenses than trying to have personal and business expenses mixed together and pull out those business expenses. So it is simpler to keep a separate card or separate account, so it's easy for you to track your expenses. And that's sort of on the basic level. On the bigger level, as you start getting involved with LLCs and S Corps, C Corps, you really do want to have separate accounts. That's more for liability reasons, to show that this is a separate business, a separate legal entity, and we don't want to mix personal expenses in there. So I think it's a really good habit to form to have it doesn't need to be anything fancy, just a separate credit card to say I'm putting all my business expenses on this card, or all my business checking expenses are going to go out of this account. So it's easier for you to track, and it establishes good habits should your business start growing to sort of the next level.
Okay, good. I like this question a lot because I know what the answer is and I like the answer. A person who's a new freelancer this year is paying their own healthcare costs or insurance costs. And if you pay for your own healthcare or for your insurance policy on the marketplace, can you deduct that? And what about medical costs that aren't covered by your healthcare?
First, I'm sorry to hear that, because health insurance is no fun paying on your own. But health insurance is deductible against self-employed income. So if I have $50,000 of self-employed income and I've got $5,000 of health insurance costs, I do deduct that against my income on the return. So self-employed health insurance is deductible against your self-employed income. I use the word self-employed because when you're paying your insurance, when you're working on your own, it is considered self-employed health insurance. If you have additional medical expenses that aren't covered, those do go on Schedule A as itemized deduction to the extent they exceed 7.5% of your income. So it is a deduction, but probably the bigger issue to watch out for is most states offer an exchange. I'm used to California, where it's called Covered California. Sometimes it's called Obamacare, but it's where you can get health insurance premium assistance. So let's say my premium is $2,000 a month and I sign up for Covered California and in between jobs, I might get a majority of that covered through the exchange. But there's a few important things to watch out for there. You have to give them an estimate of your income. Let's say I put down $50,000. If when I file my taxes, my adjusted gross income is about $50,000, there'll be no real change. If my income goes down, I might get even more premium assistance in the form of a tax refund. It comes through the return as a tax refund to help cover that medical cost. But where it surprises people is to go the other way. I was expecting only $50,000 this year, and my income jumped up to $80,000. Because your income is higher, there's less premium assistance, and you may have to pay some of that back with the tax term. So if you have a drastic increase in income, it's worth contacting your health insurance provider to let them know my income is higher, and we may need to change the premium assistance, so that you don't find out a surprise on your tax return in March or April that you owe more money than expected from that change.
Okay. We have a number of people who want to know about quarterly taxes. Who has to do it? How do you figure that out?
Nice. Yeah, quarterly taxes. Those are after your first year of being an independent contractor, because usually in your first year you say, great, I'm making a lot of money. Then you get hit with a huge tax bill. Then you start realizing maybe paying quarterly is recommended and will make my life a little easier. Quarterly taxes are based off of last year's income. So I'm going to simplify it a little bit for this example. Let's say my tax bill last year was $20,000. The IRS says I need to make quarterly payments of $5,000 per quarter, April 15th, June 15th, September 15th, and January 15th, to prepay my next year's tax. If I make all the payments, they will not charge me any interest or penalties. If I do not make any of those payments and I have the exact same income and I owe $20,000 next April, I'm going to pay about $21,000, maybe even $22,000 in taxes, because I'll have $1,000 or $2,000 of penalties and interest. It's about 8% interest annually, not monthly. So if I miss the June 15th payment and I make it a month late, I get 1/12 of 8% interest. If I make no payments, it's about 8% annually total. So it's more of a cost of money. For some people, it's recommended to make all those payments to save on the interest and penalty cost and to spread out the pain so that you're not making one big payment in April. Some of my clients say, no, I'm keeping all my money. I'd rather keep it and pay some interest than give it to the IRS ahead of time. Both work. But the key thing is it's based off of last year's income. So that example of $20,000, if I have a stellar 2023, now my tax bill is tripled, it's up to $60,000. I'm only penalized if I'm not making that $20,000 payment. If I make the four payments of $5,000 each for $20,000 quarterly payments, I now owe $40,000 of my tax return, and there's no penalty and interest on that $40,000 because it's based off of last year's tax. So if you have a big increase in income, it doesn't mean you need to pay more estimates, but you do need to plan for April. You'll have a bigger check to write. In some cases, people just pay it now, so they don't have to worry about it. Other times they say, hey, I'll stick in a 3-month CD, get 1.5%, and then pay it in April. In that same example, 20,000 last year, this year I owe 60,000 tax. It's based off last year. So the following year, now I need to make estimated payments based off of 60,000 of tax. So it'd be 15,000 a quarter, assuming my income's the same. If my income drops down, I can reduce my quarterly payments to sort of what's the expected tax is without penalty. So you guys have some flexibility, but to avoid penalties, give all things being equal, you have to make the quarterly payments based off of last year's tax. So the key thing there is if you get a windfall or higher income, doesn't mean you need higher quarterly payments. You should plan to pay the difference during tax time the following year. So I've seen some really big ones where I've had someone maybe owe $10,000 and they sold a business for $10 million. And all that difference in tax, we didn't pay till April because there's no interest on doing it. And when you're having a tax bill off a $10 million business sale, it's much more interest to go off of. So your tax software like TurboTax will show what your minimum quarterly payments are. And as long as you make those minimums, there's no penalty or interest on the quarterly payments.
People have asked if they do use a CPA or a tax professional of some sort, could be a enrolled agent or somebody like that. Can they write that off?
Absolutely. That's why I try to keep my prices so high so people get the deduction for it. Well, joking aside, that is a cost of doing business, paying an accountant. It is a deduction on the Schedule C, or it is a deduction against the LLC, S Corp, whatever kind of business side it is. So when you're thinking of things in taxes and you're spending money, you're generally saving about 33 cents on the dollar, depending on your state and average tax bracket. But out here in California, with our high 10% state tax, most people are in about an average 1/3 bracket. So if they're spending something on a deduction, they're saving about 1/3 in taxes.
So when you talked about the quarterly taxes, I don't remember you specifically talking about the Social Security part of it. And we do have a question about that. Do freelancers need to pay into Social Security?
Yes, you do. And that's one of the most painful or surprising parts about being a freelancer. So I'm going to start with the basics of that and how it factors into quarterly payments. If you're working a W-2 job, Social Security is withheld out of your paycheck at 6.2%, and then your employer pays 6.2% out of their pocket on behalf of it. So your cost is about 6.2%. When you're self-employed, you're considered both the employee and the employer. So that means instead of me only paying 6.2% as an employee, I'm now paying 12.4% out of my earnings to Social Security. So trying to keep this a simple example, if I'm in the 10% tax bracket and I'm self-employed, my tax rate is actually 22.4% because I'm paying 10% income tax plus the 12.4% Social Security tax, which is quite a shock to a lot of people the first time they're self-employed. And depending on your views of the Social Security system, it could be a good thing or a bad thing. But on your tax return, self-employment tax is calculated based off the profit in your business. So again, we have 70,000 of income, 30,000 expenses. That 40,000 of profit is subject to income tax for the IRS, to state tax, depending on your state, and then the self-employment tax, which is 12.4% on the first 160-ish thousand of profit. That does directly benefit your Social Security benefit. And when you're paying your tax bill, it's already on the form. So if I owe $20,000, part of Social Security, part of it's income tax, I don't need to separate that out. Give the IRS one check for $20,000 with the payment voucher, or pay it directly on the IRS website, and it is automatically applied between Social Security and IRS income tax based off the tax return. Same thing with quarterly payments. When you're paying quarterly payments, it's factoring in what's your total tax bill between Social Security and income tax. And then the last small part of the tax there, you're also paying a Medicare tax, which is another 2.9%. So when you're self-employed, it's 15.4% in self-employment taxes, which is Social Security and Medicare. It's no fun to have that kind of big tax bill, especially when you're used to your employer paying half. But it is slightly touching on politics. It's still important to pay into, because Social Security is guaranteed by the United States government. And I'm sort of the opinion of, if Social Security collapses, it's all over. I mean, the whole world's falling apart at that point, and money doesn't really matter. So while paying into the system, you're still building up your benefit, which can be a great help. I've done this for about 20 years now, and I've seen people who avoided paying into Social Security through various tools, and now they're regretting it because it increases by 8% per year every year you delay. It adjusts with inflation, and most other investments do not do that as well. So it's not fun to pay into, but it is, I think, worth it in the long run, given the US government hasn't collapsed. So it is a shocking thing for your first return. But specifically for quarterly payments, it's already baked into that number. You don't need to separate out what's Social Security and what's income tax. That's all reconciled on the tax return. I saw an S-Corp question on the Q&A, and that does tie to Social Security. So I'm going to talk about that for a moment. When you're unincorporated, have a single member LLC, a multi-member LLC, a partnership, you're still paying Social Security tax on your profits up to $160,000. That $160,000 goes up a little bit each year with inflation. One tool to reduce the Social Security tax is using an S corporation. When you're using an S corporation, use my same example of 70,000 of revenue, 30,000 expenses, 40,000 of profit. By the book, that 40,000 comes through on an S corporation Form K-1 to your individual return, and it is not subject to Social Security Medicare tax. You're only paying income tax on that profit. So a lot of small businesses will use an S corporation to knock off their Social Security tax. It does reduce it. It is a double-edged sword because now they have less Social Security benefit, but it is a sort of known loophole that does reduce the Social Security tax. And the higher the profit, the sort of the greater the savings. Some people who are more libertarian choose to save on their own rather than rely on the Social Security portion of it. The asterisk to that is the IRS says you must have reasonable wages in your S corporation. So if I have 40,000 of profit, I might have to pay myself a $15,000 wage. So 40 minus 15, 25 is not subject to self-employment. And by having 15,000 of wages to myself, I'm still paying Social Security Medicare tax through that wage. Reasonable wage is a very broad definition. It usually means it has to be a percentage of profits that's not too small. So if I have a business, an S corp with $200,000 of profit, I can't say I'm only paying myself $10,000, so I pay barely any Social Security. I'd need to pay something more along the lines of maybe $60,000, $70,000, even $80,000 to pay into Social Security to have the rest be exempt. So S corporations can help with that. Again, you have to watch out for reasonable salary rules and be aware that you are limiting how much you're paying into Social Security.
There are a couple of questions about information reporting, and I guess we have to explain to people what that means. But one has to do with Forms 1099. One person in the Q&A said they have severance from having been laid off. I guess a lot of people have severance, or we hope they have severance when they get laid off. And they're also getting 1099s for freelancing. So it makes it kind of confusing how you deal with all of
If,
that.
if it's a severance from a salaried or W-2 job, usually the severance is included in the final paycheck, and it's added to the year-end W-2. So if I was making $60,000 a year and I got a $10,000 severance, my W-2 would show $70,000 of income, which just goes directly on the return as normal. So it's sort of straightforward in the tax world. They add it to your payroll and withhold federal tax, state tax, Medicare, disability, and all the normal taxes that come along with it. All right, is this person saying they are receiving severance as a contractor?
No, they have severance that's reported on the W-2, and now they're also freelancing, so they're getting 1099s. And I think, sounds to me like there's confusion,
Okay.
not knowing what to do with your 1099s.
Okay, so the 1099 is the primary way that your customers are reporting to the IRS how much they pay you. So it's a form that they send one copy to you and one copy to the IRS. So for example, we have IT vendors that do a lot of security at our company. We pay them throughout the year. We send them a 1099 showing how much we pay them. And the IRS does match that up to their return. If the IRS shows $100,000 of 1099s on file under a specific social security number, and you only report 60,000, they're going to send you an automatic letter saying, hey, you're missing 40,000 of income. Here's the tax bill. Here's the penalty and interest. So the 1099 is the good example of what is my minimum amount of income I need to report on the return to make sure I'm keeping the IRS happy. What I call the TikTok tax advice is if you don't receive the 1099, it's not taxable. Not by the book, not true. If someone pays you money, you should report it. But the 1099 is the IRS's line of sight of how they tag that to your social security number. So in this specific question, if you're receiving 1099 income, that's reported as usually a small business. And if this person's starting up a new business, all of their expenses to start up that business are a deduction. And since some people here may be working side jobs or side hustles, I think that comes into you can have losses from your business, in some cases, offset your W-2 income, as long as there's material participation in the small business. So that usually means if you're spending at least 750 hours a year running that business, and it's a majority of your time, you can deduct those losses. So if I'm working 2 days a week at Disneyland, and the rest of the time I'm really working hard on starting up my own freelance business and it's running at a loss, I can deduct my loss against my Disneyland wage. So that is possible. That's something you probably do want a tax professional guiding you to make sure you're following the rules. But in general, it's if you're spending more time on the side hustle than you are at the W-2 job, you can usually meet the material participation rules, so you can deduct that loss against your W-2 income. So that is a strategy that may affect some people there.
Also, some people are getting paid through PayPal, or some people, I know we have a number of people who write books too, and they sell their books, and so they use Stripe to get paid. So that there's some new form that that the IRS is now requiring the payment companies to set to
There's
give.
a form 1099-K where for PayPal, or if you're selling more than, I think it's 5,000 in the service, they'll send you a 1099 showing you need to report this income on your return. And that's your income before expenses. You still put all your deductions and pocket expenses of that business on your return. There was talk of them lowering that amount to $600, which is just bonkers because most people just send that to friends and family throughout the year. and they've continued to kick that can down the road, which they just recently did. So they said, give us another year to figure it out. But let's say you sent a family member $10,000 through PayPal and they receive a 1099-K. That does not mean that they're taxed, but it means they have to report on their return. Here's 10,000 of income reported 1099-K, and then show this was a gift from family or something not business related, and sort of back out. It's a pain in the you know what, but it doesn't mean you owe tax just because you receive a 1099. It still needs to match reality. And if the reality is that's gifts or other non-business things, you just need to back it out on the return. You're only reporting your true business income. And there are mistakes in 1099s. I've seen clients get 1099s that have an extra zero on them or doubled up. And we use it to fix it on the tax return to show the full amount and then back out the errors. Because you never want to report less than what's on the 1099s than what's on the return. Otherwise, again, the IRS sends you an automatic love letter saying, we think there's a difference. And those situations is where a tax professional can help.
It just seems like it's getting more and more confusing, Matt.
Well, again, break it down to what's the reality. What truly happened, how much money did I actually make, reporting the total income and the deductions. In most cases there, you're going to be fine. All these 1099 rules, it's just a political circus. They'll get kicked down the road again next year before anything real comes out.
Okay, good to know. Can we just say a word or two about the Corporate Transparency Act and the beneficial ownership rule?
Yes, as long as you're not harboring illegal, laundered foreign money in your business, you're going to be okay. But the rules on that are silly because it's requiring small businesses to register. However, there's no system set up yet to register. So the current government website just says check back later right now. There's no real answer to that. But again, I think it's tied to a lot of politics. The rules are scary about penalties and stuff for not reporting, but there's literally no way to report right now. And we're in the middle of December. So we're waiting for some clarity on that. But usually when I've seen things like this in the past, they make the announcement, they give people a gigantic grace period of usually a year or more to really figure out what's happening and register, and it'll become easier to follow up. Likely it's going to be a website where you need to type in who are the owners of your company if you have a small business. And they're not targeting freelancers who 100% own the company. They're looking for, let's say I have a corporation, I own 10%, the other 90% is owned by foreigners who are not listed anywhere on the return. That's who they're looking for. So they're casting a very broad net that we fall into, but they're not looking for people like this because I don't think anyone here has significant interest in a business entity where there's foreign partners. And if there is, as long as you disclose it, there's not any penalty or problem there. How it's going to happen, we don't know yet. We'll see what they decide in the coming weeks. My sense is it's probably going to be delayed.
Okay.
Yeah.
Good news. That's good news. So we've run over a little bit. We said we would talk for an hour, and it's been a little longer than that. And I'm still looking at 18 more questions in the Q&A, and I'm knowing that we can't get to them all. There are a number of questions about business organizations. Should I have an S corporation? You gave us some reasons to have an S corporation. Should I have an LLC? Why do I need to do anything other than just file a Schedule C and be a sole proprietor? And I'm thinking that that might be something we could talk about in another webinar at another time. And there are also a slew of questions about retirement planning and all the different kinds of retirement plans that there are for self-employed people. and what's the best one and that kind of thing. And that could be yet another webinar. Will you come back and talk to us again?
I'd be happy to, except in March and April, because I'll be busy with taxes. But besides that, I did want to give the maybe 30 to 60 seconds on the entity type. Most small businesses that do not have a liability concern, you can operate as a unincorporated Schedule C to save yourself some cost and keep it simple. Beyond that, the S corporation sometimes makes sense for people who are trying to save on Social Security, which again, double-edged sword, but there's some cost to that. Now you have to pay for payroll, either via Gusto or another service, plus the extra cost of filing an S corp return. So I usually say it's Schedule C is great to start with, and as you get bigger, LLCs have the most flexibility for future changes, where S corporations are sort of locked in. So in general, it's unincorporated is fine. You're going to save some money. And as things grow, LLCs are usually the best sort of catch-all to adapt to changing careers and a changing world.
Okay. I've been, instead of listening to you, which I should have done, I've been going through the rest of the questions to see if there's anything else that I think we could answer. And there's a big question. It's a little question in the Q&A panel, but it's in my mind a big question. How many separate businesses do I have to have if I do several different kinds of work? Can I put it all into one Schedule C?
Oh, absolutely. It's recommended to put it all into one, unless there's a significant liability reason to just separate the businesses. But if it's unincorporated, you can put it all in one Schedule C. Even if it's somewhat dissimilar services, it's still total income, total expenses, bottom line. So you don't need to separate those. Usually that's only done if there's a significant liability reason and you want to keep things separate as much as possible. Like if I was running a trampoline park and being a freelance, I'd keep the trampoline park in a whole separate entity with separate books, records, tax returns, because there's high liability there of someone getting hurt in a trampoline park. But if your contracting isn't causing a liability concern, lumping it all together is not a problem, which will probably save you some time ahead of having to separate it all.
Okay. I think maybe we should cut it off. Have you had enough?
Oh, yeah, I'm happy to answer as many questions as you need. So I've got a few more minutes if there's anything else.
People have asked about SPJ membership dues. Is that the same as a charitable donation?
That is not a charitable deduction. That is considered a dues and subscription, which is a 100% allowed deduction. So for example, I have to pay for my tax research software as a yearly due, same thing as being in the CPA Society. That's all deductible part of my business development and betterment. So that is a deduction, no questions asked in that kind of audit.
So journalists who subscribe to a lot of different publications so that they can keep up on things can write off all those subscriptions.
Absolutely. Again, as long as it's within reason. So you can't count your Disney Plus subscription if you're in journalism unless you're specifically covering Disney activities. So you got to keep it within reason. But for all the other online subscriptions related to your industry, absolutely, because that's part of your market research, business development, understanding the competition. That is an absolute deduction.
Okay, good. Well, Matt, we really appreciate your taking time to talk with us about taxes. And I guess what I would like to do is make sure that Nicole, can we please put put the NorthPoint website again into the chat so that people will have that that website again, because that's the best way to get in touch with Matt, I think. We really appreciate your taking time and sharing your expertise with us. And also we want to thank all of the people who came to hear what we talked about tonight. And I guess it's afternoon out there in California.
Well, thank you. I hope it wasn't too confusing for anybody.
It's taxes. It's always confusing. And they like it that way. But thanks to all of you for joining us, and we hope to see you at our programs and webinars next year. Starting with January 24th, we'll be introducing our 2024 board members, and we'll preview our plans and priorities for the 2024 year. We hope you'll all plan to join us then. And on behalf of the SPJ Freelance Community, we wish everyone happy holidays. Thanks and good evening. And thank you all.